How did the Federal Reserve mobilize funds in emergencies? Imagine a financial storm brewing, threatening to disrupt the economy. In such times, the Federal Reserve steps in as a crucial player, acting as a lender of last resort. This role is vital for stabilizing financial institutions and markets during crises. The Federal Reserve was created in 1913, and its ability to provide emergency loans has evolved significantly since then. Initially, the Federal Reserve Act granted limited emergency lending powers. However, in 1932, during the Great Depression, Section 13(3) was added. This section allowed the Federal Reserve to lend to creditworthy borrowers who could not find credit elsewhere, but only in unusual and urgent situations. Approval from the Federal Reserve Board was necessary, along with collateral and proof that no other credit options were available. This authority allowed the Federal Reserve to respond flexibly during financial stress, although early usage was cautious. Under normal circumstances, the Federal Reserve provides liquidity through the discount window. This is where banks can borrow short-term funds against collateral, typically at rates higher than market levels. This tool is designed for short-term needs rather than systemic crises. When major financial emergencies arise, such as the crisis from 2007 to 2008, the Federal Reserve dramatically expanded its emergency lending. It created multiple specialized facilities under Section 13(3). These included programs like the Term Auction Facility, Term Securities Lending Facility, and Primary Dealer Credit Facility. These initiatives provided short-term liquidity to a wide range of financial institutions, including non-bank entities. This support helped prevent chaotic failures of large firms considered too big to fail and ensured that credit continued to flow in the economy. The 2007 to 2008 crisis showcased the Federal Reserve's ability to intervene beyond traditional banking institutions. It lent to non-banks and supported key markets. However, the extensive use of Section 13(3) authority raised concerns, leading to changes in the Dodd-Frank Act of 2010. This law limited the Federal Reserve's emergency lending to programs that serve broad sectors instead of individual firms. It also required prior approval from the United States Treasury Secretary for such assistance. In more recent emergencies, like the coronavirus pandemic, the Federal Reserve deployed emergency lending facilities again, sometimes in partnership with the Treasury. These actions aimed to stabilize credit markets and support the economy. They reflected the Federal Reserve's ongoing role as a financial backstop during crises, mobilizing funds quickly through established legal frameworks and innovative programs tailored to each situation. The Federal Reserve mobilizes funds in emergencies by utilizing its statutory authority, especially Section 13(3). This allows it to create emergency lending facilities that provide liquidity to financial institutions and markets when normal credit channels fail. Over time, this role has evolved from limited early powers to a broad set of tools designed to maintain financial stability and support the economy during stressful periods.